good afternoon, good evening, based on whatever time you're watching this video. Friends, in this particular series, we'll be seeing GST amendments in a lot of parts as well as GST circular in a lot of parts. So this would be relevant for your May 2025 exams. And this time amendments are high compared to your November 24 where there are no amendments. So it would be very, very important for your exams. Specifically the first part where you're talking about GST amendment series where there'll be a lot of parts, small parts of videos, and followed by GST circulars, and that will be again small parts. Make sure that you go through all the videos of GST amendments as well as your circulars because amendments would always carry a good amount of marks. So you don't miss out on the amendments, and it will be very important when you are writing your exam. So make sure you don't miss any of the videos, revise them thoroughly. Other areas, yes, you have to focus, but amendments specifically, you have to be having all the amendments in your hands. So that is the importance of amendments. I hope you'll be enjoying all the amendments. You'll have a lot of clarity in all the amendments and the circulars. Thank you. Yes, friends, now discussing about the amendments in your RCM specifically. Now, there are basically two items that attracts important attention. One is RCM with respect to notified goods. In section 9.3 read along with notification 4/2017 CT rate, and another is your RCM on services section 9.3 read along with notification 13/2017 CT rate. So basically there are two new entries in RCM, one for notified goods and one for notified services, both under section 9.3. Now the one which is for goods is talking about metal scrap. Now what it is telling, any metal scrap which is falling under chapter 72 to chapter 81. So lengthy chapter list is there. So any of these 10 chapters, 72 to 81, any metal scrap which is falling by these under these chapters 72 to 81 of first schedule of Customs Tariff Act, which is supplied by unregistered person to registered person, the registered person has to be under RCM. So any metal scrap for that matter, which is covered from chapter 72 to 81, this chapter basically is taken from your Customs Tariff Act because more or less classification in GST and customs are the same. So chapter 72 to 81 of Customs Tariff Act 1975, if it is supplied by a person who is unregistered and to a person who is registered, it will be covered by RCM. What is the implication of it? Unregistered to registered is RCM, registered to registered is FCM. If the supplier is unregistered, recipient is registered, then RCM. If the supplier is registered, recipient is also registered, then is FCM. So basically you can have various permutation combinations. Supplier unregistered, recipient registered, or supplier is registered, recipient is unregistered, or supplier is registered, recipient is also registered, or both supplier is unregistered, the recipient is also unregistered. On the left hand side, we have understood that we are talking about the supplier. On the right hand side, it is the recipient. So unregistered to registered, then this attracts RCM. Recipient has to pay RCM. If it is registered to unregistered, it is FCM. Supplier has to pay tax. If it is registered to registered also, then it is FCM. Supplier has to pay tax. Even if it is unregistered to unregistered, supplier is also unregistered, recipient is also unregistered, it is FCM. The only point that you have to understand is whether this person is going to pay tax or not is a question. So he may be not registered because of his threshold limit. So here either there will be no GST, if at all he is not at all liable for registration, or if at all there is GST, it will be under FCM. So out of all these four cases, only the first case where the supplier is unregistered, recipient is registered, only and only in that particular scenario, the recipient has to pay tax under RCM. So I have written here recipient. So that is for metal scrap covered by chapter 72 to 81 of Customs Tariff Act. The next entry is going to impact a lot of businessmen, rather almost all the businessmen, where we are talking about entry number 5A. The above entry was entry number 8 in notification 4/2017. Now we are talking about entry number 5A in your notification 13/2017 CT rate. Now what it is trying to tell, It is telling that supply by way of renting of any property other than residential dwelling, which means they are talking about renting of commercial property. Renting of commercial property by unregistered person to registered person. Again, more or less it looks the same, but then the same logic holds good when it is RCM and when it is FCM. So it is trying to talk about RCM, FCM, the understanding that we took in 4 examples hold goods here also. Same chart that we have taken there, it is equally applicable here also. Same thing, because condition is same. Unregistered to registered. But what is the bigger implication? They are talking about renting of residential, renting of a property other than residential dwelling. So renting of any property other than residential dwelling. So renting of a commercial property is taxable under RCM. Now understand that both these amendments are applicable with effect from 10th of October 2024. The impact of the second one. For both these amendments, whether it is your metal scrap or whether it is renting of commercial property, because property other than residential dwelling, when it is RCM is clear, it will be only in the first case that it is RCM. Both these points holds good. But what is the impact now? What is the bigger impact now? Now you cannot think of a businessman where he's not having any property on it. Generally, whether it is a big business or small business, one common expenses that you see in every business is rental expenses. Alright, so now what is going to happen is, when you talk about this rental expenses, the impact is big, very big. In this particular point, what it will happen is, they have to pay RCM. So supposing you are talking about renting of commercial property, a property other than residential dwelling, I'm calling it as commercial property, by unregistered person to a registered person, renting of commercial property. Though the technical wordings is property other than residential dwelling, it is nothing but renting of commercial property. This surely will attract RCM. Normally when we talk RCM, we always go by this logic. Pay by one hand cash ledger and get the same in other hand credit ledger. So you'll pay by cash and get in credit. But the impact is much bigger if at all this registered person happens to be under composition scheme or happens to be in regular scheme where ITC is not applicable, not available to him. So he may be in restaurant sector where ITC is not available. Now the last category is regular scheme general. Now what will happen is, in the first 2 cases there's a very big impact. Why? They have to pay under RCM, they have to pay by cash. But they will not get the input tax credit in credit ledger. If at all you are working under composition scheme or any other regular scheme, but where the rate notification is telling that you cannot take ITC. Say for example, restaurant sector, the rate notification tells it is 5% without ITC. So you are under regular scheme, but the rate notification is telling that you have to pay this amount but no ITC. You cannot take credit. You have to pay by cash, but you will not get the credit. If at all you are under regular scheme, generally, what will happen is you will pay that amount by cash ledger and you will get that amount back in your credit ledger. Pay by cash ledger, electronic cash ledger, get back that amount in the electronic credit ledger the same month. So what is the difficulty now here is, the difficulty is for the first 2 set of category where this amount what they are going to pay is going to be cost. Because normally when you pay RCM, it is not your cost, you pay by one hand, get the credit in other hand. But for them, for these 2 examples that I have taken, composition scheme a dealer or a regular scheme dealer where the rate notification tells that you cannot take ITC, that RCM payment, not only this RCM payment, any RCM payment for that matter will be a cost. For the last category, it is not going to be a cost. Why? They will pay by one hand and get the credit in other hand. So they will pay by cash and get the amount in electronic credit ledger. Though this is common for any type of RCM, this particularly is not only for renting of commercial property. It is common fact. Common fact, if at all it is RCM and if you are under composition scheme or regular scheme where ITC is not available, the amount paid will be cost. And if at all you are talking about a situation where you are under regular scheme, so you will pay that amount, RCM amount by cash ledger and get the amount in credit ledger. It is not a cost. So that is common for all. But what is the highlighting point is, renting of commercial property is a very common expenditure. a common item that every businessman will have, mainly the small business owner who will be going under composition scheme. So it will be a big headache for them. So these are the amendments when you're talking about RCM entries, one for goods category, another for your service category under section 9.3. And the logic is the same. One is goods category, metal scrap, chapter 72 to 81, customs tariff act, and other is renting of property other than residential dwelling. Common condition is supplier should be unregistered and the recipient should be registered. So both these notifications are effective from your 10th of October 2024. So now let us discuss about the amendments in your exemption notification 12/2017 CT rate along with the 9/2017 ID rate. The first one in the list is only importation of service related exemption. So therefore the notification you will find is only 9/2017 IT rate, integrated tax rate, because it is only dealing with interstate supply. All the other amendments are there both in 12/2017 CT rate as well as 9/2017 IT rate. So other amendments are there in both the notification, common for both. Now talking about the first amendment or first new entry which is there in your notification number 9/2017 IT rate, which deals with importation of services, is the new entry 10L. It talks about a situation where there is importation of services by an establishment of a foreign company, not any foreign company, a foreign airline company. So import is by an establishment of a foreign airline company. Either it is from a related person or it is from an establishment that is its branch office outside India. So the condition number one is there is import of service, but from where? It is obviously from outside India. Who's the recipient? Foreign airline company. Who's the supplier? Either the related person outside India or the branch office or establishment outside India. Other condition is it should be without consideration. So if at all this is the situation, then it is exempted. So basically you're talking about a foreign airline company in India is the recipient. The supplier is its branch office, its related person outside India, or its establishment, that is branch office outside India. This is the supplier. Now when this service is being imported, now they've got importation of services, it is exempted if there is no consideration. If at all there is no consideration, then in such a condition GST will not be there. It is deemed supply, by the way. Even though there is no consideration, it would have been deemed supply, because you need to understand if there is no consideration why it is exempted, because it is covered by the aspect of deemed supply. Now though it is deemed supply, you are talking about para 2 of schedule 1, transaction between related person or distinct person. Though it is deemed supply, it is exempted. Technically you can tell it otherwise. There is levy, but there is no collection. There is levy, but there is no collection of because of this new exemption notification. But you need to understand that there are other conditions as well. What are the other conditions? First, they clarify that what is meant by foreign company. Foreign company is the same meaning which is given to it in section 242 of Companies Act. What are the other conditions? The other conditions which are given here is it has to make sure this particular foreign company has to pay GST at applicable rates in India, both on its transportation of goods and transportation of passengers. So they are trying to tell that you pay GST on your actual supply of goods and actual supply of services, which is transportation of goods and services. If at all you're paying your taxes on your actual supplies properly, then this would be exempted. If this was not exempted, it would have been under RCM. Please understand. If by any chance it was not exempted, this transaction would have been under deemed supply and it would have been under RCM. Now that is exempted, this RCM is also not allowed. If at all it is exempted, no need to discuss FCM or RCM. It would have been under RCM. So first condition is, if you want to take the benefit of this exemption, the foreign airline company for its operation within India, transportation of goods and passengers, pay GST at correct rate. Second, Ministry of Civil Aviation should certify that this establishment of foreign company in India is an airline company which has been designated by the foreign government. So it should have been designated by the foreign government. Supposing this airline company belongs to USA, this airline company should have been designated by USA government under the bilateral air series agreement between the USA and India. So Ministry of Civil Aviation tells that, okay, we are going to give benefit to this foreign airline company if its government, that is the foreign government, has entered into an agreement, bilateral air services agreement with India. And additionally, Ministry of Civil Aviation further should certify that not only that it is this foreign airline company is designated by the foreign government, but also on reciprocal basis, Indian airline companies which are doing operations outside India, such similar taxes are also exempted. So Indian airline company, when they are doing work there outside India, for their work they'll pay the GST or any taxes properly. But there might be some services which is provided from Indian branch office to the foreign Indian airline company branch office. So there, these similar taxes, whatever exemption is here given by India, should have been given by the other country. Same services appearing in the same entry, the government of the foreign country should also give exemption. Now, basically, what are we doing? This importation of service without consideration from a related person or a branch office outside India, when it is given to foreign airline company in India, we are exempting it. Similarly, the same kind of exemption treatment should be given by the foreign government if at all it is reverse scenario. So that is the requirement. So basically, they tell that we additionally require two conditions. Ministry of Civil Aviation, I'm putting under one condition, though there are 2 points, that we will be giving this exemption of import of service by a foreign airline company from a related person or a branch office or establishment outside India if it is without consideration. No RCM, though there is levy, deemed supply, but there is no collection. It is exempted because it is without consideration. No need of paying RCM. But condition number 1, that foreign airline company, when it is doing the business of transportation of goods and passengers, it has to pay GST at proper rates. Pay GST and take the benefit of exemption on this particular entry. Second, Ministry of Civil Aviation should certify 2 things. That this foreign airline company has been designated by the, properly designated by the foreign government, telling that under this bilateral air service agreement, we are having this authorization. There will be bilateral air service agreement between India and the other country. This airline company should be designated by that particular government, foreign government. Additionally, this exemption that we are giving to the foreign airline company in India, because we are having a bilateral air service agreement with the foreign government where the airline company belongs to, similar kind of exemption should exist in that country also when it's a reverse scenario. So that is given there. So this particular entry, new entry, is effective from 10th of October 2024. And this is discussed only in 9/2017 IT rate, as it deals only with interstate supply. Importation of services is always interstate supply. Now all the other entries that we are going to discuss basically are having impact both in intrastate supply 12/2017 CT rate and interstate supply 9/2017 IT rate. So they are actually covered by both, but why I put only one notification is the entry numbers will differ. So that is the logic. Now when you talk about government services, there are certain exemptions given for the services given by Ministry of Railways and at times to Ministry of Railways with effect from 15 July 2024. Right, so these exemptions basically deals only with Ministry of Railways. So we will be seeing another government services, but now I wanted to focus only on Ministry of Railways exemption. Now services provided by Ministry of Railways to individuals should be to individuals, not a company, to individuals by way of giving platform tickets, facility in waiting rooms or retiring rooms, or cloakroom services to put your luggages, or battery operated cars for travel on the platforms, mainly used for people who are aged or who have disability, or who have got huge luggages. Luggages basically not at all, but still luggages will be carried out. So these services, who is giving? Ministry of Railways. To whom? Individuals. What all services? Other services. We are not talking about travel services, platform ticket services, or waiting room services, or you're talking about low room services for keeping the goods, or battery operated cars. That is one exemption. The other exemption is, this is in entry 9E. The other exemption is in entry 9F. Services provided by one zone or division under Ministry of Railways to another zone or division of Ministry of Railways. So one zone, northern zone of Ministry of Railways is giving services to southern zone of Ministry of Railways. So between these distinct persons, one zone or division of Ministry of Railways, that is Indian Railways, to another zone or division of Ministry of Railways, that is exempted. To take it out from the ambit of deemed supply. Otherwise, deemed supply would have hit para 2 schedule 1. Now, next is a special entry. 9 E is there, F is there, G is there, 9G. Services by special purpose vehicles. Special purpose joint ventures or companies will be formed. Special purpose vehicles which are formed only to give certain services to Ministry of Railways. So what they will have the entire infrastructure built and owned by them. So we are talking about privatized railway stations, which slowly we are trying to see in India. Though it is in a very nascent stage, initial stage, privatized railway stations. On the trains, few trains are privatized, mainly the goods trains. I'm talking privatized railway stations. So what will happen? Supposing Adani is building a private railway station infrastructure, which is owned by Adani, and it is giving that infrastructure to Ministry of Railways. By allowing the Ministry of Railways to use that infrastructure which is built and owned by them during the concession period against a consideration. So there will be some point of time. It is just like your toll charges. Private companies will build the roads for some point of time, which is called as concession period. The private companies will collect the toll charges, so that government objective of good infrastructure is achieved. Private companies objective of doing some social service plus getting some cost back is also achieved, and even the citizens enjoy good infrastructure. The same way, there are pros and cons for sure, but the same way what is being done now, privatized railway stations will be done. They will be built, the entire infrastructure will be built and owned by private entities through special purpose vehicles, and then that special purpose vehicle will allow Ministry of Railways to use it, obviously against some consideration. That is exempted. That will be there till some concession period. After that, the entire thing will go under Ministry of Railways. Now when that is happening, Ministry of Railways will also give maintenance services to the special purpose vehicles. So first service was special purpose vehicles to Ministry of Railways. Next is Ministry of Railways. When they're taking that infrastructure and working on it, they might give certain services to special purpose vehicle, mainly maintenance services, in relation to the infrastructure built and owned by those special purpose vehicles in that concession period against a consideration. So basically understand, supposing a private railway station is built by Adani. Adani will give Indian Railways that infrastructure to be used by them for a consideration. That is exempted. And then Indian Railways will give Adani certain maintenance services because they are going to maintain. Indian Railways will take over the railway station under they in charge, and they will take care of the maintenance part. So Indian Railways giving services to Adani in terms of maintenance services against a consideration during that same concession period is exempted. So here it is two way. Adani to Indian Railways to Adani. What are the two different services? Adani to Indian Railways is service by way of allowing Indian Railways to use the infrastructure which is built and owned by Adani. And what is the service given by Indian Railways to Adani? During that period, the entire infrastructure will be under the control of Ministry of Railways. They will be maintaining that. Maintenance services given to Adani. So that will be that. Both are exempted. Both will be against consideration and both are exempted. So GST won't be there. Now, so that is the entry with respect to your government services effective from government services with respect to Indian Railways effective from 15 July 2024. The next entry where amendment is there. Now there's no new entry, there's an amendment in entry number 12. So renting of residential dwelling basically. Entry number 12, there's an amendment. Correspondingly, there's a new entry created, entry 12A. And both of them are effective with effect from 15th of July 2024. Now what is the impact of both these entries? Entry 12, there is an amendment. And entry 12A, there is a new entry which has been created. Now basically entry 12 was talking about what? Renting of residential dwelling for use as residence is exempted except when residential dwelling is given to a registered person. So if at all it is given to an unregistered person, it is exempted. Renting of residential dwelling to unregistered person is exempted. If it is given to a registered person, then it is not exempted. It is taxable under RCM. So that is this particular understanding. Now, there was an explanation one to clarify that if at all there is a proprietorship concern and proprietor has taken two residential properties on rent, one for his business, say for example staff quarters, and one for his own home. For staff quarters, it is not exempt because he will be acting as a registered person if he is registered. For his own residence, which is not a business expense but a personal expenses, that still will be exempted because though that proprietorship concern may be registered, but when you're talking about his own house, then he should not be taken as a registered person. He should be taken as a normal proprietor, a normal individual who has got nothing to do with it. So that is a clarification which was already there. So we'll not spend time on it. I'm not trying to explain that area. It was already there. What is there in explanation 2? Explanation 2 tells that nothing contained in this entry shall be applicable to accommodation services for students in students' residences or accommodation services provided by hostels, camps, paying guest accommodation and the like. So this entry has put a full stop on a very long standing doubt telling that whether accommodation services given to students or accommodation services given by hostels, camps, paying guests can be called as renting of residential dwelling. Now they have said that it is not, this entry will not be applicable. It may or may not be covered by that, but it has categorically said that this entry is not applicable, right? Because this explanation 2 has been added because they have added entry 12A. What is entry 12A trying to talk about? Entry 12A is telling that accommodation services, whether it is for students or provided by hostels, camps or paying guests, etc., if at all the amount is less than or equal to 20,000 per person per month and the period of accommodation is minimum of 90 days, it is exempted. Amount is less than or equal to 20,000 per month per person, but period should be more, 90 days or more, then it is exempted. So this explanation is added for this particular point. Now both are connected. First, they have tried to say that accommodation services for students or given by hostels, camps or paying guests is not covered by this entry number 12. Entry 12 tells us accommodation service, we are covering it. It is exempted with two conditions. The amount should be up to 20,000 per month per person. Second, the stay period should be minimum 90 days or more. If both these conditions are satisfied, then it is exempted. Now, just to have a broader understanding, renting of immovable property. Renting of immovable property. Renting of immovable property. That immovable property can be residential property and can be, you can talk about a situation where you are talking about commercial property. If it is renting of residential property, then if at all you're talking, you have to categorize as both normal category, accommodation category. Normal category, accommodation is covered by entry toll. In normal category, what you have to understand is renting of residential dwelling or residential property for use as residence. For use as residence. For use as residence and given to unregistered person. For use as residence and given to unregistered person is exempted. This won't attract GST. But if at all it is not used for residence, it is renting of residential property, but if it is not used for the purpose of residence, or it is used for the purpose of residence, but by registered person, but by registered person. If it is not at all used for the purpose of residence, then it is GST will be there under FCM. If it is used for residential purposes, but it is by registered person, then GST will be there under RCM. Now, when you talk about renting of residential property, where you are talking about accommodation services. If at all it is accommodation services, there are two criteria. The amount should be less than 20,000 per month per person, plus the period of stay should be more than or equal to 90 days. If both of them are satisfied, it is exempted. In other cases means any of these two conditions are not satisfied, there will be GST, and that particular GST will be under FCM. No RCM, will be under FCM. Now, when you talk about renting of your commercial property, the point is very pretty clear. If it is by unregistered person to registered person, first of all, it's always taxable. If it is by unregistered person to registered person, there is GST under RCM. In any other case, any other permutation combinations, GST will be there under FCM. Right. So here this is the entire understanding of renting of immobile property being a residential property and being a commercial property. This covers a lot about your exemption and FCM and RCM with respect to renting of residential dwelling and other than residential dwelling. Technically, it is never called as renting of residential property, renting of immobile property, which is a residential dwelling, and this is not a residential dwelling. So they use this particular language. So this notification 12 and 12A is effective from 15th of July 2024. Now, there's a new entry which has been introduced in entry 25A, which is effective from 10th of October 2024. A very simple entry. Earlier there was a circular telling that it is taxable. Now that circular is no more of any use because it has said that any other incidental services given by your electricity department is exempted. Service by way of providing metering equipment on rent. So supposing you have taken an electricity connection for your property, be it residential or commercial, but you want a new meter to be there. So whenever they give you a meter, they will be taking metering equipment on rent or testing the meters. If you doubt the meters, you can go for testing the meters or transformers, or shifting the line from one place to another place, or giving duplicate bills, etc. etc. There are a lot of such services which EB department may give you, which are incidental or ancillary to the supply of transmission or distribution of electricity. Provided by whom? Electricity transmission or distribution utility to their consumers. So when you are talking about services given by electricity transmission and distribution utilities, to their consumers. Main services electricity, supply that of electricity, EB charges. There are some incidental or ancillary services, be it renting of metering equipment or duplicate invoices charges, or shifting the lines charges, or testing the meters charges, testing the transformers charges, etc. etc. These are all now exempted with effect from 10th of October 2024. So that is a new entry which has come here. Now, the other new entries which have come in your government sector, again, we already discussed your government sector, but in that particular government sector, we discussed only and only about Ministry of Railways. Now we are talking about other entries. Entry 44A, a new entry, Research and Development Services, and entry 66A, which has got some connection with education. Now, entry 44A tells that Research and Development Services against a consideration in form of grants supplied by a government entity or research association or university or college or other institution which is notified under section 35(1)(2) and 35(1)(3) of your Income Tax Act. So when you are giving research and development services where the consideration is received in form of grants, you're getting the consideration in form of grants. That R&D services should be supplied by whom? Either by a government entity. So that R&D services is given by a government entity or a research association or a university or a college or any other institution which is notified under section 35(1)(2) or 35(1)(3) of Income Tax Act, provided these research association, universities or college are notified at the time of supply. They should be that notification should be effective when there is time of supply. So this is only a clarification. When they should be notified. We are talking about second category. Either R&D services supplied by government entities, 1 point. Second point is research association, universities, college, etc., which are notified under section 35. So when they should be notified? At the time of supply, they should be notified. Not every day. Supposing a new research association is notified today and the time of supply was earlier, then it is taxable because notification has come only as on date. Now there's another entry, entry 66A, which talks about service of affiliation services provided by Central or State Educational Board or Council. So whenever you're talking about your school, they are always affiliated to so and so, correct? So you're talking about affiliation services given by whom? Central, State or Education Board or Council to a school, not any school, which is established, owned or controlled by government, central government, state government, union territory, local authority or government authority or government entity. So understand that service provider is whom? Central or State Educational Board or Council. That is the service provider. Central or State Education Board or Council. That is the service provider. Who is the service recipient? Service recipient is school, not any school. It should be government controlled school. The school can be controlled by central government, state government, local authority, union territory, or government authority or government entity. What is the service? Affiliation services. So supplier is Central and State Education Board and Council. Recipient is government controlled schools. Services, affiliation service. That is exempted. Please understand that you are not talking about any school. If the school is not controlled by government, then it is taxable. If the school is controlled by government, then it is exempt. That is that. And the last in the list of your exemption notification amendment is education services. Basically, one entry is substituted. Entry 69 is substituted, replaced. Right? It talks about vocational education, skill development courses. Skill development courses exemption notification was there. Now, the scope of skill development courses. So, when you talk about exemption, previously was given to skill development courses. Now also it is there. But the scope of the same is now widened compared to the old exemption given to skill development courses with effect from 10th of October 2024. So that this entry number 69, this entry was already there. It is now substituted by a new entry where exemption is now more, scope is widened. Right. So services given by National Skill Development Corporation, which was already there. National Council for Vocational Training. Now the name is changed. National Council for Vocational Education and Training. Awarding body was not there. Now awarding body is also exempted under National Council for Vocational Education and Training. So earlier it was NCVT. Now it is NCVET. National Council for Vocational Education and Training. Assessment Agency was already there. Now it is also there. National Council for Vocational Education and Training. Training body was already there. Now it is also there. Awarding training body, which is accredited with an awarding body recognized by National Council Vocational Education Training. Basically, if at all I want to tell, you will find this awarding body a new point. Otherwise, National Skill Development Corporation was there, National Council for Vocational Training was there. Now it is called as Vocational Education and Training everywhere. And secondly, awarding body concept was not there. Now that is there. In relation to what? National Skill Development Program or any other scheme under National Skill Development Corporation. This was already there, no change. Vocational Skill Development Course under National Skill Certification and Monetary Reward Scheme. Now, Vocational Skill Development Course was already there. So, first 2 points are already there. Now, the last point is an extended version. National Skill Qualification Framework, aligned qualification of skill in respect to National Skill Council for Vocational Education Training has approved. So, here you will find a bit change rather than any other scheme. Here also it is any other scheme, but they have been very specific with what? It should be national skill, any national skill qualification framework, any national skill qualification framework for giving a qualification of skill in respect of which the National Council for Vocational Education and Training has approved the qualification package. So that is a small change. Rather, whatever I have circled in blue is the changes. The name of National Council for Vocational Training is now changed to National Council for Vocational Education and Training everywhere. The concept of awarding body was not there. Assessment agency, training partners was there. Now awarding body is there and training partner should be accredited with awarding body. So that is a new concept which is more or less the same only. Right. Then in relation to what? In relation to types of courses. First 2 points are already there. The third point, any other scheme. Here earlier it was any other scheme implemented by National Skill Development Corporation. Now they are telling that any national skill qualification framework which is giving a qualification of skill in respect of which National Council for Vocational Education and Training has approved the qualification package. So that is a small change. In simple language, we have already discussed what this amendment has done. It has widened the scope of exemption given to skill development courses, which was already there in entry number 16. Now it is also there, but it is a bit widened. The scope is a bit widened. Now, entry number 71 is a time pass because they have only changed the name, so I'm not going to take it. National Council for Vocational Training, wherever the term was there, it has changed to National Council for Vocational Education and Training. The same goes with the definition of approved vocational education course. Wherever you find the term National Council for Vocational Training, they have changed it to National Council for Vocational Education and Training. So this entry 71, you can ignore it. They have just changed the name. National Council for Vocational Training. Now it is renamed to National Council for Vocational Education and Training, and that is the reason you see the amendments here. So these are all the amendments with respect to your exemption notification. 9/2017 IT rate dealing with import of services, and all the other notifications were as per your 12/2017 CT rate. The same kind of the notifications also there in 9/2017 IT rate, but the entry number may vary. Yes friends, now let us discuss about your amendments in input tax credit. Basically not much amendments are there in your input tax credit, and not so important amendments are also there. Very basic points are there. One amendment is there in your section 16 of CGST Act, which talks about eligibility and conditions for taking ITC. So there is an amendment in section 16 subsection 6, which talks about a situation where registration of a person has been cancelled under section 29 and the same has been revoked. There is a revocation of cancellation either under section 30, or the cancellation is not revoked under section 30, but the cancellation is revoked by appellate authority or appellate tribunal or court, which means you are becoming alive again. So your registration was cancelled, that is you're dead, and again your registration is alive, that is revocation of cancellation is that either by the process under section 30 or by appeals, that is appellate authority, appellate tribunal or court. Now in such a case, you need to understand that there was quite an amount of period where the registration was not at all there. So it is highly possible that during that point of time, the person would have still carried on the business and the credit would have yet to be taken. So either it might be old credit or the recent credit, but you need to discuss about the time limit for taking the credit. In such a situation where you're talking about the time limit for availment of credit. So what is the time limit for availment of credit in such a case? So they have categorically said that the time limit for availment of credit in such a cases where you are satisfying all the other conditions of your section 16 and section 17, which means the credit is not restricted under section 16 subsection 4, and you're also entitled to take input tax credit, which means it is also not restricted under section 17(5). The last date for which you can take the credit. Normally, what is the time limit for you to take the credit? So that time limit is already there. So you're talking about a situation where it is 30th November following the end of the financial year, which means 30th November of next financial year. The last return in which you can take the credit is October return of next financial year, filed before 30th of November of next financial year, or filing of annual return of that financial year, whichever is earlier. So that is already there. So this is the original time limit which is already there in the provision section 16. Now, along with that time limit, they have added one more point. So you're talking about a situation where the moment your registration is revoked from that particular time limit within 30 days. So you're filing a return within 30 days from the date of revocation of cancellation. So the moment your registration is revoked, you're going to file your return. And when you're going to file the return, it will be for which period? The period would be from the date of cancellation of registration or effective date of cancellation of registration, which means from the time limit your registration is cancelled prospectively, or effective date of cancellation, which is retrospectively. You're going to file the return for that period till the date of order of revocation. So technically it will be first return. You're going to file a return for many months. So it is only one return, but you're going to file it for many months. And that return is to be filed within 30 days of cancellation, revocation of cancellation order. So within 30 days from the order of revocation of cancellation, you have to file and compare both the time limits, whichever is later. So please understand for which period you are going to file the return. You are going to file the return from the date of cancellation, that is the order of cancellation or the effective date of order of cancellation if it is retrospective, till the date of revocation. So this is the time period for which you are going to file the return. This is a period for which you are going to file the return. This period will contain many months, multiple months. Normally, what is the time limit for you to take the credit? Normal time limit would have been your 30th of November of next financial year, or actual date of annual return of current that financial year, whichever is earlier. Now along with that, for this period you will add what? 30 days from the date of revocation of cancellation. A return which is to be filed within 30 days from the date of revocation of cancellation. This time limit and this time limit, whichever is later. So it is highly possible that the earlier time limit is already over, because the revocation may be a very long gap if at all you're going for appeals. So this is the normal time limit that we always have. 30th November of next financial year, or actual date of annual return of that financial year, which is earlier. And when I tell 30th November of next financial year, it is not November return of next financial year, it is maximum. The latest return in which you can take the credit is October return of next financial year, to be filed on or before this date. Right. Now the new entrant is in such a case where you're going to file a return for multiple months from the date of cancellation or effective date of cancellation till the date of revocation. You're going to file the return for the multiple months. within 30 days of revocation of cancellation. Here it is whichever is later. So that is this amendment, and this amendment is here a clarification because you might have missed that earlier time, and this is effective from your 27th of September 2024. Now the other amendment which has come out, which is basically there in your Rule 36. It is not Section 36, it is there in your Rule 36. So this amendment, which is there in your Rule 36, it's merely clarification where you have one of the conditions for taking the credit that it should not be a case of fraud. So how this condition is already there, that's just a small clarification. You cannot take input tax credit if at all you're talking about a person that a tax has been paid because of an order which is passed against the supplier, which is on account of fraud or willful misstatement or suppression of facts. And you might understand that order in GST can be under two sections, Section 73, Section 74. Section 73 basically talks about bona fide case. Section 74 talks about this fraudulent case, fraud, willful misstatement and suppression of facts. Now they've added this Section 74. It is merely just a clarification. Because when you talk about an order of fraud or willful misstatement or suppression of facts, it is only under Section 74. So it is only a clarification that they have attached Section 74 there, and that is a simple clarification that is given here. So there is no amendment, basically it is only a clarification by adding the section number there, and this amendment is effective from 8th of October 2024. Rather, you can tell the effective date of this amendment is of no use because it is only a clarification. So it was right from the beginning the same way. So this is amendment there in your section, Rule 36. There's nothing much. It's only a clarification that has been added. Now, when you talk about the other rules which have been affected, which is Rule 36, 37, 40, etc., wherever there was reference of GSTR 1, you'll find GSTR 1A. Whether it is Rule 36, 4A or Rule 37A or Rule 40, you find GSTR 1A. This in detail we'll understand in written filing chapter because this is a consequential amendment because of the amendment there in written filing chapter where they have introduced something called as GSTR 1A. So when we understand GSTR 1A, all these points automatically will be there. So wherever, not only this place in ITC chapter, there are a lot of other chapters where you'll find this amendment, and we'll not discuss much about it because it is a constitutional amendment. Wherever in GST Act or rules there was a reference of GSTR 1, they have attached GSTR 1 or as amended form GSTR 1A. So basically it is GSTR 1, or if you have amended it in GSTR 1A, it is GSTR 1A. What is GSTR 1A? What is the impact and all? We'll discuss that in your written filing chapter. So you'll have a great clarity there. And all these amendments with respect to GSTR 1 is all effective from your 10th of July 2024. As I said, even in your document chapter, there's no amendment per se, because this amendment which you're seeing in your Rule 48, where they talk about serial number of the invoices should be electronic furniture in GSTR 1. Again, I'm not going into technicality, just they have added or as amended form GSTR 1A. So this amendment again is a consequential amendment because of your amendment in written filing chapter. There is a new form which has been introduced, which is in line with GSTR 1, which is called as GSTR 1A, where you can make amendments immediately after filing your GSTR 1. So that will be discussed in your written filing chapter. And all those amendments pertaining to your GSTR 1A are effective from your 10th of July 2024. Right. Now, basically, we have seen that in your ITC chapter, there are no much amendments. Basically, only one important amendment are there. So, few amendments were dealing with GSTR 1A, which has got no significance because it is because of 1A being added in written filing chapter. Every place where GSTR 1 was used, they have added 1 and GSTR 1A. So, that is the document chapter, no such amendments. Only 1A, 1 and 1A has been added now. In ITC chapter, there was one more amendment which spoke about your ITC cannot be availed if at all someone has paid the tax pursuant to an order of demand because of fraud, willful misstatement and suppression of facts. Basically, that was under Section 74. They have clarified that it is section 74 case. No amendment. Only amendment that you could find in ITC chapter basically was a time limit when your registration is cancelled and later on that is revoked. So that is an amendment that you could find in your ITC chapter. Now, when you talk about your registration chapter, yes, there are quite a few important amendments that we have to focus on. So when you talk about registration chapter, in section 23, there's a notification which has been released pursuant to section 23, notification 5/2017 CT, where you're not required to take registration in certain cases. When, if at all you're engaged in making, if at all you're engaged in making only and only supplies where the entire tax will be paid under reverse charge mechanism by the recipient, then in that case, supplier need not take registration. Supposing I'm making my supplies and all my outward supplies, I'm not going to pay tax, only my recipients are going to pay tax, then I need not even get registration because I'm not going to contribute much. So it goes this way. Supposing I'm the supplier and there are my multiple recipients, recipient 1, recipient 2, recipient 3. And all my supplies, for all my supplies, it is taxable under RCM, which means my recipient 1, recipient 2 or recipient 3 are going to pay taxes. Then there is a notification by way of notification 5/2017 CT, which tells that I need not get any registration. The logic is quite clear because I'm not going to pay any tax. So it gives relaxation to the supplier, telling that I need not take any registration. So to that extent, it is very fair. But we are going to discuss in your RCM chapter that they have introduced an RCM entry for metal scrap. Right. So when you talk about metal scrap, they have introduced an RCM entry, which we'll be discussing. Now that entry, metal scrap, when you talk about RCM for goods under section 93, which we have already touched upon. So if you recall RCM part, we will have already touched upon that metal scrap when is supplied by a unregistered person to a registered person, it is attracting RCM. Now what may happen is, I am an unregistered person and if I am supplying to a registered person, it is always under RCM. So I'll be enjoying the benefit of not getting registration because of 5/2017. Because all my supplies, if I am unregistered and the opposite person is registered, every time it will be RCM, I will not at all take registration. So what they have done, they have said that this notification 5/2017 CT is not applicable to a person who is engaged in supply of metal scrap under chapter 72 to 81 of first schedule of customs tariff act. So this you have already touched in your RCM section 93 RCM, where we have discussed about RCM entry. Now please understand that 4/2017 CT rate, when you are talking about RCM for supply of goods under section 93, we have already touched that. So if your supply is made of a metal scrap falling under chapter 72 to 81 by unregistered person to registered person, it is always RCM. So now what have they said? I'll take the same example to explain the impact. Now they are telling that this relaxation will not apply. So supposing this supplier is unregistered and all these recipients are registered person. Now, if at all this was applicable in a normal scenario. So the earlier example that we had discussed is there in a general scenario. Now we are talking about special scenario where you are talking about your metal scrap. Right. So now what is going to happen is, obviously understanding the situation, you will always tell that yes, it is always RCM, it is always RCM, it is always RCM. So basically you will tell that no, 5/2017 CT rate is applicable and the supplier need not get any registration. Now what is clarified is this would not be applicable, which means 5/2017 will not help him and this supplier may end up in getting registration because of his turnover, which is under section 22 read along with section 23 notification 10/2019 CT. So if his turnover is crossing 40 lakhs or 20 lakhs or 10 lakhs, he might have to take registration or other reasons, because of other reasons. For example, if at all he is making interstate supply of these goods, he might very well have to get registered. So please understand that this notification 5 bar 2017 is not applicable to a person who is dealing with metal scrap being unregistered person and supplying to registered person. Though it is under RCM, it will be under RCM as long as he is getting registered. Now they are telling that he might have to get registration because of various reasons. One reason might be his turnover is crossing 40 lakhs, 10 lakhs, or 40 lakhs or 10 lakhs as the case may be. Other reason could be he is making interstate supplies. In all such cases, he has to take registration. And please do understand that the moment he is taking registration, it will be a case under FCM. RCM won't be applicable there. Then the recipients need not pay tax. Right. So they are categorically telling that they're just interlinking that RCM entry with this 5 bar 2017 CT rate. Yes, when a metal scrap is supplied falling under 72 to 81, chapter 72 to 81 of Customs Tariff Act by an unregistered person to registered person, it is RCM. But not every time. And this supplier might have to get registration because of turnover or because of other reasons. The moment he is registered, no RCM, no relaxation of 2017 CT. He has to take registration and he will end up paying FCM. Because please understand that when I tell about 5 bar 2017 CT rate in a general situation where all the cases are covered under RCM, you are not required to take any registration irrespective of your turnover. So this benefit will not be applicable now to a supplier of metal scrap. So that is the amendment which is brought out in notification 5 bar 2017 CT. The same is effective from your 10th of October 2024. So that is the first amendment in your registration chapter. Now, the second amendment which is there in your registration chapter is there in your Rule 8 4B. So when you talk about your the Rule 8 of CGST rules, there is a rule called as Rule 8 Sub-Rule 4B, which talks about for a risky category assessee who has done Aadhaar authentication. So you have done Aadhaar authentication, but for a risky category assessee, you have to get again biometric identification, biometric verification. So again, biometric based Aadhaar verification you have to do. But for whom? For a risky category assessee, not for all assessees. Supposing you are applying for registration, you are authenticating your Aadhaar. Generally, what will happen? There will be no physical verification. There is no need of biometric Aadhaar authentication again. But selected assessees which are categorized as risky assessees by the system, what will happen? They have to get biometric based Aadhaar authentication again. Now, central government earlier said that they will specify the states where this rule will not apply. Biometric based Aadhaar authentication will not apply. Biometric based Aadhaar authentication is given in Rule 8 4A and it will not apply for the states covered in Rule 8 4B. Now understand that presently, this biometric based Aadhaar authentication is applicable in all the states. There is no relaxation given to any state. So normally central government will give a list where it is not applicable, Now, if you see the non-applicable list, no states are mentioned. Technically, it means that this biometric based Aadhaar authentication which started with Gujarat, then later on went to Puducherry, then Andhra Pradesh, now it is applicable in all the states. So if at all you are selected as a risky assessee by the system where you have done your Aadhaar authentication, but the system is telling that no, there's something that needs to be verified, then you have to undergo the process of biometric based Aadhaar authentication again, and this is applicable in all the states with effect from 10th of July 2024. Now that is the amendment in your Rule 8 Sub-Rule 4B. Moving on, there's an amendment in your cancellation part of registration which is there in your Rule 21. So Rule 21 talks about cancellation of registration by the officer suo motu in certain cases. Now in such a rule, first amendment is very technical, normal amendment that they have added along with, if at all your outward supplies in GSTR 1 is more than GSTR 3B, officer may suo motu cancel it. Now they have said that outward supplies in GSTR 1 or as amended GSTR 1A. So this is because of your written filing chapter amendment where they have introduced a concept called as GSTR 1A. So wherever GSTR 1 is there, throughout GST, whether it is Act or rules, they have added GSTR 1A. So that is not so important because that understanding will have in a written filing chapter. This is only a consequential amendment because of change in return filing chapter. But the next amendment is important. If at all you're talking about a situation where you're violating the provision of third or fourth provision of Rule 23(1), then again your registration will be cancelled. Now let us understand this. Assume a situation where your registration has been cancelled, right? And you apply for revocation of cancellation of registration. Your registration was cancelled because you're not filing your returns. So you file your returns, right? So the provision goes in this way. You have to file certain returns until the returns which are due as on the date of cancellation, right? And within a particular period of time. So when you file those returns, your registration will become alive again. But that's a attached condition. After your registration is alive, you have to file balance pending returns which are due as on the date of revocation of cancellation within 30 days of revocation of cancellation. Which means if you don't do that, now they have added a provision. Your registration again will be cancelled. So this amendments in Rule 21 is effective from 10th of July 2024. Now let me explain the second amendment here. First amendment is only because of return filing process. Assume that your registration is cancelled because of non-filing of returns. You file your pending returns which are due as on cancellation order. So when you do that, your registration is revived again. So that is revocation of cancellation. Revocation of cancellation. Now the first step is your registration is cancelled because of non-filing of returns. You file your pending returns but which are due as on the date of cancellation order. Then your registration is revived again. This again you have to do within a time limit. Your registration is again alive. Now your registration is again alive. Please understand that there's a condition that you have to file the balance pending returns. You have already filed first set of returns. You have to file balance pending returns as due as on your revocation order because you have got revocation. And this has to be done within 30 days. So this is a condition before you apply for revocation. So first set of pending returns you have to file at a particular date. And this is a condition which you have to satisfy after revocation order. This condition is before revocation application. Before you apply, you have to file your pending returns. So the condition number 1 is before you file for revocation, file your pending returns which are due as on cancellation order. After you get revocation order, not revocation application, after you get the revocation order, you are becoming alive again. You have to file the balance pending returns as on the revocation order within 30 days. Within 30 days. And if at all you don't satisfy this condition, by any chance, if at all you don't satisfy condition, your registration again will be cancelled. You're back to zero. Your registration was cancelled because of non-filing of returns. Your registration again will be cancelled because of again non-filing of returns. Again because of non-filing of returns, but the second part of pending returns again because of non-filing of returns. So they have added this. So this is the entire flow. Your registration is cancelled because you have not filed your returns. Before you apply for a revocation application, file your pending returns which are due, the due date which is already gone as on the date of cancellation order. You will get a revocation order, which means you have become alive again, your registration is live again. Then the second condition is within 30 days of revocation order, you have to file the balance pending returns due as on the date of revocation order. It will be few returns. Now, if you don't file that within 30 days, you are back to square one. Again, your registration will be cancelled again. So that is given here. Now, when you talk about next amendment in your registration chapter, it is again not a very important amendment. The reason being this amendment is only because of your change in return filing process, Rule 21A, which talks about suspension of registration. So wherever you had GSTR 1, they have added as amended in GSTR 1A. So this is again because of your return filing process. This is a consequent amendment because of your introduction of GSTR 1A in your return filing process. So supplier will file GSTR 1. There are some corrections. You can go with GSTR 1A. Ifs and buts will be touching in your return filing chapter. So this is a consequential amendment effective from 10th of July 2024. Please understand when this GSTR 1A is introduced in return filing chapter, which is a follow-up of GSTR 1. Any place in Act or rules where there was a reference of GSTR 1, they have added GSTR 1A. Need not focus much on. Yes, friends. Now let us discuss the amendments which are there in your payment chapter. Starting with your Rule 86, which talks about your electronic credit ledger. Again, it is not an important amendment because it is a consequential amendment because of amendment in your Rule 96, which we'll discuss in your refund chapter. Nevertheless, what have they done is, when you talk about your electronic credit ledger in Rule 86, there was a reference in Rule 86 4B to Rule 96 sub Rule 10. So it was talking about if at all a registered person deposits the amount of erroneous refund. So if he has got erroneous refund and is depositing that again because of section 54 3, he has got the refund, or under Rule 96 3. But there was a reference to 9610 in contravention of Rule 9610. So there was a reference to that particular 9610. Now that Rule 9610, it is not at all that there's no such restriction, which we'll be discussing in detail in your refund chapter. Because of that amendment in Rule 96 sub Rule 10, here this particular impact is there. So because there is no such restriction which is there now in Rule 9610. Previously there was a restriction. When you talk about exports, there are two categories: on payment basis, on under LUT basis without payment. Right. So earlier when you go for export or supply to SEZ on payment basis, and if there were certain notifications where if you opt those notifications, you don't have two options. Normally for zero rated supply, you have two options: on payment basis or under LUT. But for certain notifications, you don't have on payment basis, you can go only under LUT. Now that particular certain notification restriction is removed. Therefore, there is an amendment in Rule 96 sub Rule 10. Therefore, you have an amendment in Rule 86. So in simple terms, you need not focus on this amendment because the amendment has come because of a rule which is Rule 96 sub Rule 10, which is touched in your refund chapter. Right? It's only a consequential amendment effective from 8th of October 2024. Rather, before moving to Rule 88B, which is dealing with interest, I'll touch Rule 88C, which talks about your difference in your GSTR 1 and 3B, difference in liability. Now, whenever there is a difference in liability between GSTR 1 and 3B, as already discussed, the moment they give reference to your GSTR 1, that will always be added along with GSTR 1A. Again, this is nothing but a consequential amendment because of your change in return filing process, where a supplier can file GSTR 1 and followed by, if he wants to do some amendment, in GSTR 1A. Effective from 10th of July 2024. So again, this is a consequential amendment. Why I am focusing on first your Rule 88C and Rule 86, because both these amendments have got no impact in payment chapter. Something has happened in some other chapter. So in return filing chapter, they have introduced the concept of GSTR 1A. Therefore, there's an amendment in Rule 88C. So technically, there's nothing changed in 88C. And similarly, there's an amendment in refund chapter in Rule 96 sub Rule 10. Because of that amendment, there's an impact in payment chapter, Rule 86. Again, technically nothing has changed much in Rule 86. So you not focus on these rules when you're revising. Now, talking about a rule which has changed something consequentially, not consequentially, which has changed something drastically, is your interest rule. When you're talking about calculating or computing your interest under section 50, right along with your Rule 88B. So here there's actually a change which has come in Rule 88B. Now, what it is telling, normally you pay interest on your gross output liability or net output liability based on the situation. If at all you're filing your return late, but the transaction is reported in the same month return, then interest will be on net output liability. Subject to it is self-assessed by the SSC and not found by the officer under section 73-74. In cases where the liability is determined by the officer under section 73-74, interest will be on gross output tax liability. And in cases where a transaction of 1 month is reported in another month's return, then again interest will be on gross output tax liability. So this was already very much there. Now, what is amendment? Amendment is not with respect to the principal amount on which interest is computed. It is with respect to period. Now, what is the situation that they are talking about? If at all you have credited that amount, the payment that you have to make in your electronic cash ledger as per your section 49 before the due date of filing the said return, but the same is adjusted against the payment for payment of taxes after the due date of filing of return, this period will not be taken for your interest calculation, as the amount is lying in the ledger from the due date of return till the date of debiting. So what they are trying to tell, that's a due date. You have made the deposit in cash ledger before the due date of return, but used it while filing the return after the due date of return. And in that point of time, the amount remained in cash ledger. So interest won't be calculated on that period. Now let us understand this with the help of an example. Supposing you're talking about your December 2024 return. So the due date of which is, let us talk about a regular taxable person and going under MRMP scheme, monthly return, monthly payment scheme. Now, the due date of this particular return is your 20th of Jan 2025. Assume that for this particular month, your gross output tax liability is 10 lakh, ITC is 7 lakhs. So the net output tax liability that you have to deposit in cash ledger is 3 lakhs. So this amount has to be deposited by way of cash. Now talk about a situation where you have deposited 3 lakhs in electronic cash ledger before due date, that is say 18th of Jan 2025. But you have filed your return and adjusted the amount in cash ledger, which means only when you file your return that amount will be allocated, adjusted against the liability. So when I'm talking about adjustment in cash ledger means this has been adjusted against your liability of 10 lakhs. Totally 10 lakhs is your liability, 7 lakhs is paid by credit ledger and 3 lakhs is paid by cash ledger. Now, your return has been filed, say on 25th of Jan 2025. Please do understand, for late filing of return for 5 days, there will be surely late fees. Now, previously what was happening, for late payment, interest also would have been calculated. So along with your late filing of return for 5 days, 20th Jan to 25th of Jan, there will be a late fees for 5 days. But now what they are telling, normally interest also would have been computed for 5 days. Though you have made the payment on 18th Jan, interest also would have been computed for your 5 days at the rate of 18% per annum, because late payment, technically you have made the payment earlier, but it was considered as late payment. Now what is the logical amendment? They're telling that no interest. Why no interest? The reason is you have deposited this 3 lakhs amount before your due date of payment, 18 Jan. So technically you made the payment in cash ledger. The only fact is in your return it was adjusted on 25th of Jan. Until that point of time, 3 lakhs remained in cash ledger. It should not have been that happened that 3 lakhs again went out from cash ledger. It should have been that during this time limit, 3 lakhs. During this particular time limit, your 3 lakhs was intact in electronic cash ledger. Then they are telling that no interest, because the amount was actually paid in electronic cash ledger before 20th of Jan. The only some procedural thing, that is adjustment against the liability, was done only when your return was filed and your cash ledger was adjusted against your liability ledger, and 25th of Jan we will not charge any interest. So that is this particular amendment. But understand that this amendment has a limited applicability only in a situation where you're depositing the amount in electronic cash ledger. If at all is not depositing the amount in electronic cash ledger, the amount has come through TDS or TCS means, then the interest would have been calculated for 5 days. Also very limited liability. Assume that, first thing, in the same example, if you got the amount in electronic cash ledger by way of TDS or TCS, which has come on 18th of Jan 2025. In that scenario, please understand that there would have been no such relaxation. Interest would have been calculated for 5 days, because it is only talking about the payment in cash ledger, not automatically coming in cash ledger. No relaxation. Second situation, if at all the amount would have been deposited in electronic cash ledger on say 22nd of Jan 2025 and followed by filing of return on 25th of Jan 2025, then please understand, even in this case interest will be for entire 5 days. It won't be there for only 3 days. The same logic will not hold good. So if the amount has come in your electronic cash ledger by way of TDS TCS, though it has come on 18 Jan, but nothing will change. The due date was and you filed your return when? You filed your return on 25th of Jan. We are taking the same example. Though the amount came by way of TDS TCS on 18 Jan, but return was filed on 25th of Jan, this will not be considered. Interest will be calculated for 5 days. Or you have deposited the electronic amount in electronic cash ledger after the due date. You did not deposit before the due date 20th Jan, you deposited on 22nd of Jan and return is filed on 25th of Jan. Even here it will not be helped. Technically, if you apply the same logic, you would have said that interest is only for 3 days. No. This is only when deposit in cash ledger is before due date and return is filed after due date. So this will not be helping you out. Interest will be still for 5 days. So this is the amendment that has come out in your payment chapter, calculation of interest, which is effective from your 10th of July 2000. So this is an important thing that you need to remember when you're calculating interest. Yes, there are certain important things that can come up. You can have this in a form of a practical question, but be cautious. This is applicable only when the deposits are made in cash ledger, not automatically coming by way of TDS TCS. Secondly, this is applicable only when the deposit is made before the due date of return and return is filed after the due date of return, not otherwise. So that is an important thing that you need to focus. Now, talking about an amendment which is having a great impact for this for this particular exams is your amendment in your return filing chapter. So your return filing chapter has underwent a draconian change in terms of introduction of GSTR 1A. So that is this thing that we are trying to understand first. Now let us first understand the amendment which has come in your rule 59, which you are talking about filing of your GSTR 1, and the consequent amendment which has come in your rule 60, that is your GSTR 2B. So introduction of GSTR 1A in your rule 59, specifically proviso to rule 59 sub rule 1, right? So that is introduction of GSTR 1A, and correspondingly what is the impact in GSTR 2B, where you're talking about the recipient's point of view, 1A and 2B. So first we'll see amendment in 59, rule 59, and correspondingly what happens in rule 60. So 1A versus 2B. Now first let us understand what is this GSTR 1A. Now government has brought out a new concept called as GSTR 1A, where you can where a supplier is filing GSTR 1 as outward supplies, and if at all there are any amendments, he need not wait for the next return to come. He can include it in the same period return, which is GSTR 1A. He need not add it further. So if at all after filing your GSTR 1, the details of outward supplies, but before filing your GSTR 3B, the supplier at his own option, what he can do? Amend or furnish the additional details. He can either amend or furnish additional details. Portal as of now allows only amendment, but slowly it will allow even additional adding extra details in a form called as GSTR 1A, which is to be filed through common portal, either directly or through notified centers by commissioner. So that is the scenario. So what is this entire thing all about? Supplier, what he does? As a supplier, supplier files his details of outward supplies in a form called as GSTR 1. So supplier will file his outward supplies in GSTR 1. This has to be furnished, and recipient will get that in GSTR 2A and 2B. This was already there. There's a difference between GSTR 2A and 2B. 2A is dynamic, it keeps changing. 2B is static. What we use for written filing basically is GSTR 2B. For annual return, we use GSTR 2A. So that is already there. Now, what has happened is, this is furnishing. So when you talk about supplier doing it, this is furnishing it or filing it, and this is auto populated. The recipient does not does anything, it is auto populated. So supplier files his outward supplies in GSTR 1, sales. In simple language, it is sales in GSTR 1, and recipient get the details of his inward supplies. In simple language, it is purchase. In GSTR 2A, which keep changing, and GSTR 2B, which is static. And for written filing process, for normal written filing purposes, we do use GSTR 2B. Only for the purposes of your annual return, we do use your GSTR 2A. Now, what is the change that has been brought out? This particular change is now supplier after filing GSTR 1, but before filing is GSTR 3B, because supplier basically will file two returns. One is GSTR 1, the details of your outward supplies, followed by GSTR 3B. So supplier will file GSTR 1 and GSTR 3B. One will only and only contains the details of outward supplies, but 3B will contain details of outward supplies, that is output tax, inward supplies, that is input tax credit, and payment will be done only in 3B. 1 will not have any payment facility. Now, what is the amendment that has been brought inside? In between this particular time, after you file GSTR 1, but before you file GSTR 3B, a supplier, if at all he has given wrong details in GSTR 1, he can amend that in GSTR 1A. So this again is the details of outward supplies, but what will happen is he'll amend. If at all he has given some wrong information in about a particular transaction in GSTR 1, wrong GST number, he can amend in GSTR 1A. Or assume that if at all that is one supply which has been missed out in GSTR 1, that can be added. So even extra information can be added. Portal is as of now not allowing, but it will surely allow it later. So either you can correct the details given in GSTR 1, or you can give additional information. Because when you see the provision, it provides for both. Either you amend it if at all it is wrong, or you add additional details. You can add supplies as well, additional information. Now, you might ask, what is the advantage of it? The advantage of it is, supposing in GSTR1 you have given the sales information as say 1 crore, but actually it is 1.5 crores. So you can add that extra 50 lakhs here, and finally in your auto-populated GSTR3B, though you can change that figures which is coming, what you will file is 1.5 crores. So when finally notices are coming, it will not take the details of 1 and 3B. When notices are coming, it will see 1 along with 1A and 3B. 1 along with 1A in total is 1.5 crores and 3B is 1.5 crores. So it will not give you any notice. Otherwise, what will happen? That 50 lakhs that you have missed out, you will add it next month. So for the first month, it will be 1 crore in GSTR1 and 1.5 crores in GSTR3B. In the next month, there will be a figure. Supposing next month the turnover is 2 crores. In one, it will be 2 crores plus 50 lakhs that you have missed out. And in 3B, it will be 2 crores. Supposing you are talking about 2 months. April month and May month. April month turnover is 1.5 crores and May month is 2 crores. I'm only talking about your outward supplies. Now let us assume that you don't have GSTR. You don't have GSTR 1A. What would have happened? Supposing by mistake, if at all, you would have reported only 1 crore in GSTR 1, but you realize the mistake in 3B and you report 1.5 crores and pay tax on 1.5 crores output tax. Right? What you should have done? In the next month, you would report 2 crores plus 50 lakhs that is missed out. Plus 50 lakhs that is missed out. And in 3B, you will report the right thing, 2 crores. So what will happen when you compare here 1 versus 3B? So you will find that there is a difference of 50 crores. That is not 50 crores, 50 lakhs here. 0.5 crores here. 1 versus 3B, and here again 0.5 crores. So net effect is 0, but that difference will come. Now what will happen after the introduction of GSTR 1A? If at all you realize or recognize that mistake after filing GSTR 1 but before 3B, you will add that 50 lakhs immediately here. Therefore, there is absolutely no need for you to add it in GSTR 1 of the next month, that is May month, and therefore the difference between 1A compared with 3B will be 0 in both the months. So that is the advantage of your 1A. Right, 1A, please understand that you can file if at all you know that you have committed some mistake in GSTR 1 immediately after 1 but before 3B. So that's the time there. After you file 1 but before you file 3B, you can correct the mistakes by using your GSTR 1A, which will help you in avoiding litigation in future. Otherwise, unnecessarily, there will be questioned by the department, okay, why there is more sales in GSTR 3B in April and why there is less sales in GSTR 3B in May month. So that question could be easily avoided. So it will help you if at all you realize the mistake after filing GSTR 1, but before you file GSTR 3B of the same month. Right, so that is this particular understanding, introduction of GSTR 1A. So whenever you see 1, always you will find that a lot of points we have already covered. Always you have to see 1 along with 1A in totality. And it is not only additional information, you could correct it. So you have given wrong sales data, wrong GST number of a party, you could change that also. I have taken the extra information of additional information. So that is the purpose of GSTR 1A. The purpose of GSTR 1A. Please understand that 1A can be filed after filing GSTR 1. After you file GSTR 1, but before you file GSTR 3B of the same month. So that is an important thing that you need to remember. Now that in a way helps you out in case whatever additional details that you're filing in GSTR 1A as a supplier immediately filed after the due date of GSTR1 but before the due date of GSTR1 of the next month. That will appear in GSTR2B. So technically it means that it will appear in GSTR2B of that same month. So whatever extra information that you file of GSTR1 in form of GSTR1A after the due date of GSTR1 of previous tax period. In our example, if at all you have taken April, GSTR1 due date of March month, but before the due date of GSTR1 of current tax period, it will reflect in 2B. Now let us understand what is the impact and what is the problem also we'll understand. Theoretically, it might not give you the entire meaning. Supposing that is April month, right? And you file GSTR1, we'll continue the same example showing 1 crore. Right, this GSTR1 showing 1 crore is filed on say 8th of May. Immediately you realize a mistake and you understand that you have missed out 50 lakhs and you report those 50 lakhs, that is 0.5 crores. Right, on this was done on 8th of May and this you do it on 10th of May. This you do it as a supplier. This you do it as a supplier. Your output supplies. As a recipient, you'll get the details of your inward supplies. Now, as a recipient, you'll get the details of your inward supplies in your GSTR2B. So let us not talk about 2A because 2A is used, it's dynamic and it will be used only for your annual return. Let us focus on GSTR2B. Now, in your GSTR2B, you will get the information of 1 crore GSTR2B of which month? The GSTR2B of April month itself, which means recipient can take the credit in the month of in the return of April filed in May. In the return of April, which is going to be filed in May. What about this one? So, as regards 1, this will appear in 2B. What about 1A? If you strictly understand, this will also go, supposing there are two recipients, 1 crore, 1 sales and 50 lakhs, 1 sales. Let us only assume that there are only 2 sales. One is of 1 crore, one is of 50 lakhs. The first recipient will get that entire 1 crore in GSTR2B of April. He can take the credit in April return filed in May. Second case also, the second recipient also will get this information in GSTR2B, which is of 50 lakhs, that is 0.5 crores. Ideally in the same month, because 2B means what? 2B, if at all any details is filed by the supplier, any details which is filed by the supplier in GSTR1, now it is along with GSTR1A before the due date of GST. What is the due date of GSTR1? The due date of GSTR1 is 11th May. This would appear in GSTR2B of the recipient in April return itself, which is going to be filed in May month. Correct. So not only recipient 1 who was purchased for 1 crore will be able to take the credit, because ITC is available only for the recipient when it is appearing to be. So the recipient will be able to take the credit in April itself, not only recipient 1 but also recipient 2. He will also be able to take the credit in April return itself. This is theoretical. But what is the problem practically? Why? Be it GSTR1 or GST. If at all I have, I have a time limit to file GSTR1 between GSTR1 and 3B. Correct. Between GSTR1 and 3B can also be 10th of May. I need not wait till 18th of May or 19th of May or 20th of May. After I file GSTR1 and before I file GSTR3B, I can always file GSTR1A. So in between period can also be, it could be a scenario where one is also filed before due date of GSTR 1 and one is also filed before due date of GSTR 1. Highly possible. But the portal will not allow you to file GSTR 1A before due date of GSTR 1, which means portal will allow you to file your GSTR 1A. Even though you realize your mistake immediately, you file your GSTR 1 on 8th of May. You realize that it should have been 1.5 crores, but I have reported only 1 crore. So balance 50 lakhs or 0.5 crores, I have to report it. You try to do it on 10th of May, it will not allow you. Only after the due date of GSTR 1 is over, which is 11th of May in a normal scenario, portal will allow you to file your GSTR 1A only after that. Though provision tells that you can file it immediately after filing GSTR 1 and before filing GSTR 3B of the same month. But technically, portal will give you the option of filing GSTR 1A only after due date of GSTR 1 is over. Which means, though you know the mistake on 10th of May itself and you try to add that 50 lakhs, you cannot add it. You can add it only on 12th of May. Now, what is the impact? If you can add that only on 12th of May, for the recipients of 50 lakhs, they will not get this in April GSTR 2B. They will get that information in May GSTR 2B. After the due date of GSTR 1 of April month, but before the due date of GSTR 1 of May month. So what will happen is the recipients of 50 lakhs or 0.5 crores will be able to take the credit only in May return. Though the supplier has identified the mistake before the GSTR 1 due date and he has already filed GSTR 1, he wants to file GSTR 1A before GSTR 1 due date, but he will not be able to file it. He can file that information only after the due date of GSTR 1, which means as a recipient, those customers who are purchasing for 50 lakhs, they will get those inward supplies information not in April month's GSTR 2B, but only in May month's GSTR 2B, which means they can take the credit only in their May return, not in their April return. So if you look from the angle of recipient, recipients who purchase for 1 crore, they will be able to take the credit in April return itself because it has been reflected in GSTR 2B of April because the supplier has filed GSTR 1 before the due date. But that 1A 50 lakhs is filed by the supplier after filing GSTR 1 but before filing GSTR 3B. Now, an additional information is not as per law, it is as per portal. Portal, technically as per law, you can file it after GSTR 1 before GSTR 3B of that one. But portal does that, yes, you can file after GSTR 1 but before GSTR 3B, but only when the GSTR 1 due date is over. So, when you understand that, you can file that GSTR 1A after GSTR 1 and even after due date of GSTR 1. After filing GSTR 1, even after due date of filing GSTR 1. Right. Whichever is later. After actual filing of GSTR 1 or due date of GSTR 1, whichever is later, you can file only after that. And that makes the recipient of 50 lakhs get that particular 50 lakhs in their GSTR 2B, not in April but in May return, and they can claim the credit only in May. So that is because of portal. So that amendment is there in your Rule 60. So I have explained what is a drastic change in your written filing process with the introduction of GSTR 1A. Not only that, we have understood vis-a-vis GSTR 2B. So Rule 59 and Rule 60. Now the other places where you have amendments, I'll just highlight it so that we need not go through that again. So there is an amendment again in Rule 60 itself where they talk about 1 and 1 is always read along with 1A. This is a consequential amendment. And by the way, please understand the written filing process has undergone change with effect from your 10th of July 2024. So the consequential amendment also has gone with, which is with effect from 10th of July 2024. In other place of Rule 60 also there is a consequential amendment because of 1A. Wherever you find GSTR 1, you will find GSTR 1A. Not only in your Rule 60 other part, but also in your Rule 78, which is all about your matching of details filed by ECO in GSTR 8 and supplier outward supply is filed in GSTR 1. So 1 along with 1A. That is also with effect from 10th of July 2024. I want to just tell that these are all consequential amendment. Not of much important, because the written filing process has underwent change with the introduction of 1A. Wherever you find GSTR 1 in any place in Act or rules, you will find 1 or 1A. Now, the other amendments which are there. Now, the other amendment which is there in Rule 59 itself, specifically Rule 59.4, and there's a new rule which has been introduced, 59.4A. 59.4A is also consequential amendment. Whatever you can report in 1, the same thing you can report in 1A. So I'm not going to touch that particular thing. So you have to report B2B and B2C in different parts. The same thing. 59.4 talks about reporting in GSTR 1, and 59.4A talks about reporting in GSTR 1A. The same thing, additional, same thing, exactly same things. So that is again a consequential amendment. But what is the amendment in 59.4? How to report in 1 as well as 1A. So we are dealing your GSTR 4 as well as your GSTR 1 as well as 1A in terms of 59.4 and 59.4A. So be it your GSTR 1 or GSTR 1A, Rule 59.4 or Rule 59.4A, what are they trying to tell? If at all it is B2B supplies and B2C supplies. B2B supplies, whether it is interstate or it is intrastate, it has to be reported invoice wise. Same thing, there's no amendment here. So B2C, whether it is interstate or intrastate, generally it is consolidated, but wait, there's a small change here. So this has to be reported. B2B is always have to be reported invoice wise, one by one. If there are 1,000 invoice, 1,000 line items. 1 lakh invoice, 1 lakh line items. B2B. B2C, if it is interstate, supposing I'm there in the state of Tamil Nadu and I'm making supplies outside the state, but my customer is unregistered. B2B means my customer is registered. B2C means my customer is unregistered and my customer is there in other state. If at all, invoice value, the value of that particular transaction is more than 2.5 lakhs. So earlier it was 2.5 lakhs. Now that 2.5 lakhs has changed to 1 lakh. So earlier the limit for reporting B2C interstate was applicable in a case where the invoice value was more than 2.5 lakhs. Now that is reduced to 1 lakh. So that is the amendment. So now 2.5 lakhs is changed to 1 lakh. So that is the amendment that we are talking about. Now it is no more. 2.5 lakhs. This is amended to 1 lakh. If the invoice value, the transaction value is more than 1 lakh, then this also has to be reported invoice wise. Interstate, other cases. It has to be reported consolidatedly. Intrastate, any case means whether the invoice value is more than 1 lakh or less than or equal to 1 lakh, consolidated. Consolidated means one line item. So consolidated transaction will be applicable in a scenario where it is B2C interstate. If it is interstate and if the value is more than 1 lakh means invoice value is more than 1 lakh. That transaction, supposing there are interstate B2C transaction, there are 1,000 transactions, out of which 5 transactions are more than 1 lakh. Invoice wise, 5 items invoice wise. Other transactions are all less than or equal to 1 lakh. Then what will happen? You can report it consolidated, but consolidated when you're reporting consolidated state wise. It's not all the states one line item. So I have interstate supplies from Tamil Nadu to Maharashtra, and assuming all are less than 1 lakh, one line item I can report. I have hundreds of transactions Tamil Nadu to Maharashtra, interstate B2C. I can report it as one line item. I have hundreds of transactions Tamil Nadu to West Bengal. Interstate B2C. I can report it one line. I have hundreds of transactions Tamil Nadu to Delhi. Interstate B2C. I can report it one single item. State-wise. I cannot merge states state-wise. But if I have out of all those hundreds and hundreds of transactions B2C, interstate, there are 5 transactions which are having invoice value more than 1 lakh. That I cannot consolidate. That I have to report it line by line. We call it as B2C large. But when it is intrastate, within the state, I have thousands of transactions B2C within Tamil Nadu. Within Tamil Nadu, then I don't see 1 lakh, more than 1 lakh or less than or equal to 1 lakh. Any case, I can report it consolidatedly. B2C Tamil Nadu, one line item. Thousands of transactions, but one line item. So what is the amendment that is there? The amendment which is there is previously B2C large interstate was 2.5 lakhs. Now B2C large interstate is 1 lakh. That is the amendment which is equally applicable in 1A. Now, what is the other important amendment? By the way, last amendment in your return filing chapter is GSTR 4 due date, which is there given in your Rule 62. So when you talk about your composition scheme dealer, they make payment quarterly, CMP 08, and they file return yearly. Now, the due date for GSTR 4 earlier was 30th April of next financial year. 30 days after the financial year. 30th April of next financial year. Now, from financial year 24-25 onwards, the due date is 30th of June of next financial year. For a composition scheme dealer, yearly GSTR 4 due date is changed from 30th of April of next financial year to 30th of June of next financial year. And this is effective from your 10th of July 2024. So normally when you talk about GSTR 4 due date of any financial year, you tell that after the financial year is over, 30 days, which means 30th April of next financial year. But now that has changed to 30th of June of next financial year. So due date of GSTR 4 has gone a change. That is all about the amendments in return filing chapter. Basically, you'll find 3 core amendments: introduction of 1A and the impact in 2B, due date of GSTR 4, and other amendment is when you talk about B2C interstate transactions, large, definition of large, invoice wise reporting, 2.5 lakhs has changed to 1 lakh. Now talking about the amendment in TDS and TCS. Now they have introduced TDS when you talk about your metal scrap. Metal scrap we have discussed in your RCM chapter. We have also discussed in your registration chapter, and this is the 3rd chapter they're discussing TDS. Normally TDS was applicable when you talk about government and government agencies and government companies and government undertakings contract. Now it is only even for, it is not only for those government contracts, but it was also for metal scrap. Any registered person. So when you talk about your TDS, it is given under section 51. Now what is the amendment by virtue of notification 50/2018 CT, where they have added one more list in the TDS applicable parties, that when you talk about your notified persons who are required to deduct TDS, now a registered person who is getting a metal scrap falling under chapter 72 to 81 of first schedule of Customs Tariff Act, if he is purchasing from another registered person, TDS will be applicable. Now this TDS applicability again is with effect from 10th of October 2024. All the amendments dealing with metal scrap is effective from 10th of October 2024. Now let us try to understand. Supposing you're talking about supplier being unregistered. Recipient 1, recipient 2, recipient 3. Till he is unregistered, and all the recipients assume that they are registered, the recipient will pay under RCM. That is the first amendment. We are talking about the entire discussion is all and all about metal scrap covered by chapter 72 to 81 of Customs Tariff Act 1975. But understand that supplier cannot remain unregistered for a long time. right? He has to take registration because of the turnover or because of any other reason, which means if his turnover is crossing 40 lakhs, 20 lakhs or 10 lakhs, or if he is making interstate outward supplies, etc., he has to get registration. He will not get the benefit of 5/2017 CT. So that is the second amendment. Now, assume that after some point of time, the supplier is doing a great business and he is registered. Now, suddenly the supplier becomes registered. The recipients, the same recipients are there. So, till one point of time, he was unregistered. Now, the same supplier has become big. He is starting having turnover which is more than 40 lakhs, 20 lakhs, 10 lakhs as the case may be, or he started making interstate outward supplies or any other reason. For any other reason, he has got registered. Now, the moment he is registered, all the transactions are taxed under FCA. No more RCM. RCM is applicable only if the metal scrap is supplied by unregistered supplier to registered recipient. Now, it is no more RCM. But what will happen is, these recipients will now deduct TDS. Supplier will charge GST on their invoice FCM, but these recipients will now deduct TDS. These recipients now will file your GSTR 7, and this TDS amount they will pay by cash, and the supplier will get in cash ledger. So till there is some work for the recipient. If supplier is unregistered, recipients who have registered have to pay under RCM. If supplier becomes registered, now it is no more RCM. But these recipients who are registered, supplier is also registered, recipient is also registered, they have to deduct TDS. They have to file an additional return. They have to take one more registration and they have to file GSTR 7. GSTR 7, they will deduct and pay TDS in cash ledger in a separate return GSTR 7, and the opposite person, supplier, will get that amount in his cash ledger. That is the entire amendment with respect to metal scrap covered by your chapter 72 to 81 of Customs Tariff Act. All these provisions are effective from 10th of October 2024. There's another amendment which is there in this chapter, but now with respect to TCS. The earlier was section 51 TDS, now it is with respect to section 52 TCS. TCS is applicable when you are supplying goods or services through electronic commerce operator, where section 95 is not applicable, and consideration is also routed through ECO. Supplies through ECO, consideration is through ECO. Please understand, earlier the rate of TDS was 2%, now also it is 2%. Earlier the rate of TCS, maximum rate is 2%, but notified rate was 1%. Now that 1% is reduced to 0.5%. So your TDS rate remains 2%. TCS rate, which was 1%, is changed to 0.5% with respect your notification 15/2024 read with 1/2024 IT. 15/2024 CT read with 1/2024 IT. The TCS rate is reduced from 1% to 0.5% with effect from 10th of July 2024. Please understand, TDS rate was 2%, it remains 2%. TCS rate was 1%, it is now changed to 0.5%. If I tell 0.5%, if it is CGST, SGST, TCS, it is 0.25, 0.25. And if it is IGST, TCS, it is 0.5%. So that is the amendment which is there in your TDS chapter. Introduction of TDS for metal scrap when supplier is registered and recipient is also registered, and the rate of TCS, which was earlier 1%, section tells maximum 2%, but it was 1% till 10th of July 2024. Now it is reduced to 0.5%.